The good news out of China this week is that we finally got the numbers for the full year 2015 breakdown of GDP, and it turns out that capital spending did in fact fall. The background being that capital spending has been 46-47% of GDP for the last 5 or 6 years, which is exorbitant and has caused a huge run-up of debt. But of course that's what you get with a savings rate that's nearly half of GDP at 49%, and in fact that did come down last year, but not quite as much as capital spending. The motive factor to a great extent was a slump of import prices, which has therefore helped net exports in value terms to increase, even though import volume increased by more than export volume. But this can't go on forever. Although it is only fair to say that the slump of import prices was a major help to the consumer sector, where real growth was 7.5%. But when you've got an aggregate that's 44% of GDP needing to go down, that tends to drag everything else down with it, and it's very hard for consumer spending to grow by enough to produce reasonable growth, which means that China must depend upon net export volume growth in future, which in turn depends upon devaluation at this point, because you're not going to get a slump of import prices like we've had ever again within the near future. So what we're saying here essentially is that devaluation, which so far has been helped a little bit by the increase of the yen and the euro, is probably going to be needed against the dollar itself. The Chinese will probably want to postpone this till after the US elections to avoid getting in the middle of a political fight. And that means that this year's rebalancing could be quite small, and the increase of debt, which resumed in the first quarter, could start to be of concern again.